Welcome back, and today on the Currency Derivative Corner, in association with MSCI, we are joined by Amit Pabari, who is the Managing Director at CR Forex. Amit, thank you so much for joining with us this afternoon. And Amit, I want to just start by talking about, the volatility in the rupee, which is actually at a multi-month low, is that making Indian corporates a bit complacent in terms of hedging their currency? What is the current scenario that we are seeing as of now? Before we get into more details on that.
And definitely, if we compare the volatilities at multi-month low, thanks to RBI, who has been managing it very well on both the side of the market. And because of that, exporters are getting more and more complacent because of two reasons. One, the forward premiums, which was trading at 5.5%, 6%, it has come down drastically to 1.5%. It doesn't give any motivation for an exporter to go and book forwards. Second reason is regency effect. As we have seen last year, rupee has moved from 72 to 82, 82.5 level. Exporters are still believing that Fed is going to still aggressively increase the rates in coming days, and rupee is going to depreciate towards 84 and 85. Because of this reason, exporters have really become complacent and they are not willing to hedge aggressively.
Right. Amit, typically what I want to understand also in this market is that when we look at it normally, is that any product that is traded in the spot market and trades at a multiple time in the derivatives market. However, when you look at it in terms of the exchange traded currency derivatives, that's not the case for the products. How do you see the potential for the ETC CD market in India? What is the growth that is there, and what is it that you're looking at?
If I have to compare when we started our career as a consultant, we found that, there is no alternative platform. We have to only go and hedge in the bank. But in last 5-7 years, currency derivative segment has grown multiple times, thanks to, all the players in the market who have made it very, very lucrative. Now, there are major advantage if you are hedging via currency derivative. First, bank market gets closed at 3:30. Currency exchange is open till 5 o'clock. So that extra 1.5 hours, you get time to hedge your currency exposure. Second, as far as documentation is concerned, it is very easy to go and book in currency derivative as compared to bank. Banks require a lot of data point and a lot of formalities have to be done. So as far as documentation is concerned, currency derivative is much better segment to go and simply book your exposure. Third, what I wanted to tell a lot of exporter and importer, even if they are small, they can hedge via option. Option liquidity, price transparency is much better as compared when a smaller exporter of 50 crore, 100 crores want to hedge that option, even simple vanilla option via bank, it is not possible. So because of all of this reason, we have seen the volumes in the currency derivative have increased over the time, and we are continuously expecting that the volumes are going to increase. And any business which have a monopoly kind of a scenario, that is not good for the client. When you have an alternative hedge platform like currency derivative, it is good for both the market players and the hedgers.
Right. Amit, I'm going to pick out one of the points that you were mentioning in terms of exporters that are small and small businesses as well. Individually, when you talk about that, can small businesses and even individuals use this currency derivative market, and how can they use it? If you could give an example in terms of a strategy they could use for this currency exchange, what is the risk that is there for them? If you could explain that.
Yeah. Say, for example, if a smaller exporter or an importer want to hedge via option, whether the bank is going to give them a correct pricing, they will have an ambiguity with respect to that. But when it comes to hedging via option in currency derivative, the price discovery, price participation is very, very clear. No one has to tell an exporter or importer or trader that what is the price. He can see it in front of his screen. Okay, what is the price? Second, and the price holds good for whether you are trading as small as $10,000 and $1 lakh. In the bank, when you go there, you will not get the same amount of price for all kind of volume. So if someone wants to hedge $10,000, the price might not be same. If someone wants to hedge $1 million, the price might be different. So for MSME, this is a fantastic place. There they can really go and explore, and they can be rest assured that the pricing are better as compared to a bank where they have to go and negotiate.
Right. So pricing is surely one factor that they should be considering as well. And what is your suggestion for any of the corporates who are still not hedging? What would your advice be for them?
We have been in markets from last 15, 20 years, and we have observed that history suggests us that a bull market will typically end with a good news, and a bear market will typically end with a bad news. And regency effect of all exporters is that the currency is going to get devalued towards 84, 85 kind of level, because Fed is going to continuously increase the interest rate. But at CR Forex, we feel that Fed is at the top of the hiking cycle. Probably in next 2-3 months, they're going to stop hiking the interest rate, and in next year the rates are going to come down. So if this scenario happens, definitely, and with RBI intervention, we are expecting that 83.25, 83.5 will be a top for rupee, and we will expect a reversal in the pair. So it is very, very important that any exporter who is not hedging, they should keep a stop loss policy, or if they do not want to keep a stop loss policy, then at least hedge via option. So even if the rupee appreciates, they do not get business loss.
Right. And, Amit, if I just want to understand currently, what is the contribution of these corporate hedgers in the ETDC market? How are you looking at it in terms of the contribution from them?
Exact data point, it is difficult because spot market data point we do not get from the bank side. But ETC volume has definitely increased by 8 to 10 times in last 5 years. So roughly we can say that 10 to 15% of the corporates have moved as an alternative, has been using currency derivative as an alternative platform to hedge their exposure. And within few years, the volume will increase tremendously. That is what we are expecting.
Right, Amit, thank you so much for joining in with us this afternoon and giving us an understanding on the currency derivative market. That was Amit, the Managing Director at CR Forex for y'all. So thank you so much for that, Amit.